Awesome. So we're really excited to get to pick your brain today about accounting and tax strategies to maximize cash flow for this segment. Amy, if you want to go to the agenda slide, we'll talk a little bit about how we're going to do that. So some housekeeping before we get started. This webinar will be recorded and we will send that in a follow-up email. In addition to that, you'll notice that the format is a little bit different. Typically, webinars can be kind of present-y, but this is really an opportunity for us all, Amy, myself, and the audience, to pick Jay's brain on this incredibly important topic. So if you have any questions throughout the webinar, please ask them. We will do our best to ask them in context, depending on the section that we're in, or at the end of the webinar. So to get started, we have a lot of topics to get through. The first thing is that Amy, Jay, and myself we're kind of talking about accounting and tax strategies, and we came to the realization, well, it's not really a realization, but accounting and tax strategies are unique to different businesses based on their stage of growth. So how do we communicate the most value possible in a way that's structured, easy to understand, and easy to follow? And we came up with this idea of building 3 scenarios to guide our thinking. And we hope that most of you that are joining here find yourself within one of these 3 scenarios, and therefore will be able to get advice that is very specific to your particular use case. So Amy, we'll get to the next slide and talk about what those 3 scenarios are. So scenario number 1 is Breezy Boutique, which is an S Corp, and they operate on a GMV of roughly $3 million. They're selling unique fashion-forward clothing items. They work on a made-to-order model where manufacturers produce and ship products directly to consumers upon order placement, so drop shipping effectively, and functions with a small remote team dedicated to design, customer service, and marketing from a home office. We have Tech Masters, who is our first C Corp, and they're doing around 10 million in GMV. They manufacture their own innovative tech gadgets, and they maintain inventory across all of their warehouses. Healthy Bites, which is the last example of these 3 scenarios, operates on roughly 25 million GMV and creates and sells organic, vegan, and gluten-free snacks. And they hold a large product catalog, but they maintain minimal inventory because they have a good partnership with food producers who are doing most of the fulfillment. These are the 3 scenarios that we're going to take you through as we dive in to the different accounting and tax strategies that will help you maximize cash flow. So Amy, we can go to the next slide and we'll jump into the first section, which is kind of foundational to everything that we're doing here. But effectively, it's about selecting the right accounting method for your e-commerce business. There are a few e-commerce methods that you can select. 3 specifically, we have cash, accrual, and modified cash. Modified cash we'll get to in the next slide. But before we dive in, I'll let Jay kind of provide a high-level overview of each of these accounting methods, as well as their corresponding pros and cons.
Matt, thank you. So cash method, I mean, we're all used to that. And we know that most tax basis is based on cash and when you get paid and when you pay your expenses. And that's basically what cash method is you record the revenue when the cash hits your bank account. You record the expense when the cash leaves your bank account or hits your credit card, not necessarily when you pay the credit card. So that is really the simplest method out there. Now, accrual is a little bit different. And accrual is where we want to really match the expenses to the revenues in the period that they occur. So, you know, we have our e-commerce website, and we might also be doing some wholesale orders off of that website. So we're pushing orders out 2 ways. We're pushing them out as they're getting paid for, and then we're also pushing orders out as they occur, and then we're booking that over to accounts receivable. Well, in both of those cases, those are sales on the accrual method. As soon as that sale is made and the items are shipped, that's considered a sale. On the cost side, it's more about when that product ships and we're matching the cost of those sales to the revenue that we're making, not just when we're paying for it. So when we're looking at a P&L, we get much better numbers if we're looking at an accrual method P&L. But sometimes from a tax strategy, the cash method is much better. And from my perspective, if you are a manufacturing company, you are so much better to be on the accrual method because you're bringing in goods at different prices. In some cases, you are actually putting labor and other resources and overhead into those products. You want to capture all that so you know what the cost is of the products that you're actually selling. So you can actually calculate a good gross margin and know what you're making off of every product. Whereas on the cash basis, you buy $100,000 worth of inventory. Well, that's hitting COGS immediately. And you might be selling that over 6 months and you're going to be running at a loss situation. Well, it doesn't really give you a really good feel for where you look there. So and that's kind of where modified cash comes in, if we want to jump the slide ahead one more. So modified cash is we operate everything on the cash basis, but we account for the inventory on accrual. And we actually run it through the inventory accounts. And that gives you the best of both worlds. You get the proper cost for the items that are sold at that point, and you have a better picture of what your P&L looks like at that point as well. So it gives you better information to make better, timelier business decisions from your accounting information. So.
Yeah, I feel like in our experience, one of the things that we notice is the smaller you are and the earlier you are in your journey, cash is typically best because it's the simplest. And as you start to grow and scale, you then transition over to modified cash and then eventually into full accrual. And I think it's important on the full accrual side to mention that from an IRS requirement perspective, what is the inflection point where you have to move over to accrual?
So prior to the Tax Cuts and Jobs Act that was passed in 2017, that number was $10 million. And with the Tax Cuts and Jobs Act in 2017, that was effective 2018, they pushed that limit to $25 million in sales. And that is an average of the last 3 years' sales. And basically, that is the determination of a small business per the IRS, 25 million in sales or less. So, up to that point, you have a question, and that question came up a lot in 2018. Should we stay accrual? Should we go to cash? What should we do? And we ran a lot of scenarios, and we'll talk about that coming up here shortly.
I will, it's interesting. I will say, and then we'll move into the scenarios, that one of the things that we found is that on the accrual method, it does set you up more so for acquisition or potential investment down the road. It's one of the requirements to get outside funding for the most part when you're dealing with VCs or banks, so on and so forth.
Right. And that all comes into play with GAAP reporting, because GAAP is different from tax. I mean, you might maintain 2 sets of books, one on the accrual basis, one on the cash basis, specifically for tax. And we could do that within Xero and QBO and some of the other platforms we use. We just tell it, hey, let's calculate that income on the cash basis instead. But when companies are undergoing due diligence and they're looking at purchasing your e-commerce business, they're going to want to see it on the accrual method, because it might be a VC firm that's undergoing audit. They're going to have those numbers in GAAP format. And GAAP is generally accepted accounting principles for those that aren't aware. And that is basically the standard that financial statements are reviewed.
Yeah. Also, that's where the benefit of working with an outsourced accountant or bookkeeper comes in. If you're doing cash, it's a little bit easier to do it yourself. But then when you start to transition into modified cash and accrual, it starts to become a little bit more complicated. So let's dive into the scenarios. We'll get into Breezy Boutique first. That is an S Corp. Again, fashion, drop shipping, $3 million in GMV. If they were knocking at your door, which accounting method would you recommend?
So in this case, either really works fine, because it's going to be the same. Because when you're doing drop shipping, you're not paying for the inventory ahead of time. You're paying for it when it's shipped. So in this case, either method works fine. Or if you're buying the merchandise from them, maybe they're going to work you a discount to prepay for it. They're just going to warehouse it for you. In that case, cash basis might work very well. You know the exact amount you're paying per product, So if you needed to, you can actually get a really good estimation of what your cost is on your sales and know what your profit margins are. But from tax perspective, maybe, you look at it from either method at that point. It just depends on the exact scenario.
Yeah. So if we're looking at it in the most basic sense, cash is likely best suited for this person if it's kind of like a very cookie cutter drop shipping scenario, $3 million in GMV.
Yeah.
Not a lot of complexity in keeping the numbers up to date, and puts you in a good position at the end of the year when you're thinking about filing taxes.
Yep.
On the flip side, we have the tech masters who are a C Corp manufacturing their own product, doing $10 million GMV, doing a lot of their own shipping. What would you recommend in this case?
Yeah, and like I said earlier, if you're running a manufacturing business, I recommend you stay on the accrual method because, you're bringing in raw materials constantly. Those values are changing. You don't want to just book all your raw materials to cost of sales immediately. And then, as you're trying to analyze the cost and your profit margins over the year, they're going to fluctuate, and you're not going to be able to pick that up unless you're really keeping a separate set of ledgers to know what you're paying for each raw material. So if you're doing it right, you're going to use an inventory system. You're going to create purchase orders, bring in those raw materials, bring in the packaging materials, and build those bill of materials to create those products. It's going to include cost of your resources, your overhead, and your labor. And that's going to give you the hard cost to make that product every time you produce it. And by doing so, you're going to carry that in inventory. And when it's sold, the system's going to calculate what the COGS is, cost of goods sold, and you'll be able to know what your gross margin is by product, by order, et cetera, at that point. It makes it so much easier to do that. And there is an effort, but if you stay on cash, you're going to have an effort to actually make business decisions. It might come out better in the short term for your tax situation. And we'll talk about tax situations and the different methods later. But I definitely recommend for a manufacturing business to stay on accrual.
And I think what's interesting, right? You had mentioned tax here. Like, these aren't necessarily strategies to help you maximize cash flow yet, but they are the foundation to get to.
But in order to get to those tax issues and tax planning and budgeting, you really have to have really good numbers, so you know what's coming out and where the cash is coming from and what your tax liability is going to be. And in some cases, when you're on the cash basis, it's really hard to predict where it's going to change. You have a budget of, we're going to sell X number of units this year. And based on that, we know what the cost is, but we don't know what the cost is on cash, because you might have to buy a whole other batch of raw materials and put out a large amount of cash, and you don't know what that cost truly is. So it's much easier to budget on accrual when you have numbers like that.
And then the last scenario, I feel like we teased at what the answer is here when we talked about the IRS thresholds. But so we have Healthy Bites, who operates on roughly 25 million in GMV, hint, hint, creates and sells organic, vegan, and gluten-free snacks. They don't hold the inventory. They work with a partnership, a food producer who does most of the fulfillment. What would you recommend in this case?
Yeah, as they're coming up to that 25 million, I think cash or accrual works. But once they hit that 25 and exceed it, they have to go on accrual at that point.
Yeah. And you can see we strategically place these numbers to effectively make a point.
What does it look like when you're switching from your cash to accrual?
Well, it's not something that you can easily do, and you can't switch every year. There is a process when making changes in your tax accounting with the IRS, and there's a form. It's a lengthy form called the 3115. And I know this because we just did a cash to accrual conversion for one of our clients. And we did that, and we timed it. We were looking at when the best time was over the last 3 years. And this year was the best time to do it because there was you basically have to go back and calculate what the effect was of that change. And then you have to add that. If you're bringing in more income, you have to add that into your income, and you have to pay that tax on that income when you make that change.
Gosh.
So, and in this situation, the company went through a number of changes at 12/31. So we elected to make all that change effective and the tax due this first year. But they do allow you to spread that out over a number of years if it's going to be a large enough number and be a greater impact. But it's something that you have to apply to the IRS and do it early, because you have to get their permission on some of these changes. There are what are called automatic changes and then non-automatic changes, and changing to or from cash is a non-automatic change. So you want
What
to do
about modified cash?
Yeah.
Is it, do you still have to fill out that form?
Say that one more time.
A modified cash, do the same
Yeah,
rules
if you're
apply?
changing from a straight cash to modified cash, it's a change in accounting method. So you have to do that. Yeah.
Okay, awesome.
Is there ever a situation where you're better off, like if I was a seller and I was looking ahead and I thought I'm going to have to make this switch, I guess maybe earlier is probably better if you're seeing some growth?
Like I said, we looked at the numbers and determined it. You know, we knew coming in about October that this was the year we wanted to make that change based on what the income was looking at and looking at the difference between cash and accrual. And because of that, we were able to plan ahead. We did all the numbers and we followed that return, followed the 3115, and we don't have to look back at that point.
Got it.
But yeah, you want to know what your numbers are. And that's, again, why it's so important to track your sales and COGS and all of your expenses, because it's really difficult to make business decisions if you're not tracking your numbers and know what your profit is. And you can't forecast cash flow if you don't know what that is either. And you really need to have your sales and know what your AR days are, what your AP days are, so you can actually plug all that into your cash flow forecasting and be able to get an idea of when is that cash going to be higher, that we might have a higher tax bill this year. How does that all work? So it's really important to have timely, clean numbers. And that's one of the reasons I've been using A to X since I found it. It's like 6, 7, 8 years now. Why I love using Xero, and it just it makes it so much easier for me to help my clients have the information they need.
Yeah, and we'll get into that a little bit later in terms of technology, but when you are making that transition, there is tooling to help it transition a little bit smoother. So next to the next foundational accounting component, which is accounting for inventory. Amy, do you want to go to the next slide? And then Jay, can you talk us through FIFO and LIFO, the pros and cons, and then we'll apply both to the 3 scenarios that we have in place?
Sure. So under GAAP rules and under tax rules, you can have inventory under a FIFO or first in, first out, under LIFO, last in, first out, weighted average. But there are advantages to both of them at different points. And again, you can't change back and forth how you're doing the valuation, because again, that's a change that the IRS, it's a reportable change and you have to get permission for it. So FIFO is the most recognized, most used, and it is basically the inventory that hits your door first is the first to go out. And when you're doing that, you're ensuring that, and let's look at something that has an expiration date, that product that's coming in, you want to make sure that it's going out the door before it expires or it's unusable. So if it does go unusable, then it's unsellable, and then you're going to write off that inventory, and that's definitely a hard cost. Now, by using first in, first out, you're sending that out first over the things that were purchased last. And like right now, we are under inflationary times, and the items that we're bringing in now cost more than they did a year ago. And by doing that, we're well, not purposefully, but if we're using LIFO, we're going to have a higher cost of goods sold and a lower profit. And you got to look at that as well. But with LIFO, you're leaving that older inventory and it could go stale, and that's going to cause you to have to write that off. And it's much better to use LIFO, in my opinion, in most cases, because you want to get that product that's been in, the longest out the door, because, you might change packaging, you might change instructions, there might be different things. You don't want to be sending out the old package on something where you've changed it and people can recognize it. I mean, it doesn't look good. So get that older inventory out early, get it out first, and don't worry about the costing methods on it from that perspective. It's better from a product and a warehousing standpoint to be on FIFO.
Nice. I think on the LIFO side, there are maybe, and I'd love to get your perspective on it, like a few cases where it might make sense. Like if you're dealing with any materials that fluctuate in cost, especially in inflation. I just think about anything involving lumber, right? Remember when like lumber was going through the roof? If that was like a big part of your product offering, like LIFO might have been advantageous,
right?
In that context, because you're obviously accounting for the increase in cost.
Right. And that's what I was saying, that higher costs during inflationary times, you might have a higher cost. And, during these inflationary times, cash flow becomes much more tighter than it would be when prices are normalized. So by having the higher cost, lower profit, it does impact your profit, your net income, and your tax due. So maybe in those times it's actually beneficial. And like lumber probably wouldn't go bad unless it's going to over time.
Yeah.
But and that's the thing you have to look at from that point. But it should be fine being on your shelf a little bit longer than the product that was just purchased. And that's the one high point that I see with LIFO, is you will pay less tax because you have higher costs due to inflationary periods.
Those are very specific situations.
Yeah.
And I guess jumping off of Amy's question about like how easy it is to switch from cash to accrual, is the concept similar to FIFO and LIFO? Like once you pick one, it's pretty hard to switch to the other?
Yeah, it's the same process to make that change. You have to have a change in accounting method or a valuation method, and you have to go through that same process with the IRS, and you're going to have to revalue that inventory. And if your costs go up, well, you might have a shift in income, and you might pay or actually have a loss situation based on it. And every situation is different when it comes to tax. And I highly recommend, if you're looking at something like that, to reach out to a tax firm like High Rock, where we would do an analysis and give you a plan on that and tell you, okay, if you were to do it, this is what the impact is, and this is the possible tax impact on it. So that's so important to look at it, because every tax situation is different, and it might be a S corp or partnership where that income passes through to the different partners, and based on the different partners, it would have a different impact on how it would be dealt with. Totally. So there are a lot of factors in why you want to look at making changes like this on a very specific basis.
So speaking to that, given your lean towards FIFO and looking at these three scenarios, would they all, in your opinion, fall under FIFO, or would you recommend LIFO to any of these?
Well, since you're not stocking the products for those drop shipments, you're going to pay whatever that current charge is on that product. So yeah, that's going to fluctuate, and you're not carrying that inventory and be on your books. On the case of tech gadgets, technology does go stale and does age. Yeah.
Poorly.
And you don't want to leave those products sitting in your raw materials that long, because then you're going to be stuck. You're going to have to write it off, donate it, something. And even if you have to pull that out of your warehouse and send it somewhere, there's a hard cost to that. And then you're going to write off some of that, and you will see a tax benefit from it, but you won't see a cash flow benefit from that. If anything, you're going to be dipping into your wallet to pay for disposal or transportation of those stale products. So again, in this case, any type of food manufacturing, anything with lot numbers and expiration dates, definitely FIFO is the way to go. The other products where you might not have those, again, we could run some numbers and figure out what the impact is and what the best method is to go on that.
Nice. Cool. All right, Amy, I think we're ready to go to the next section.
Sure, I will just quickly ask, and this question might be better suited in the tech section, but we had a question just about A2X and FIFO and LIFO. So obviously the COGS tool that A2X has is just sort of fixed. You input your COGS and that can work sort of for smaller businesses, but obviously larger businesses, we would recommend they use an inventory tool. Jay, does it suit you to talk about those inventory tools now, or would you prefer to do that in the tech section?
Let's talk about that during the tech section. Yeah, for sure.
Awesome.
And I'll hit on my thoughts there as well with A2X.
Awesome.
As well.
Perfect.
And thanks for asking questions. If anyone has questions throughout, please send them through, and we'll do our best to address all of them. So the next section is tax payment schedules. Amy, if you go to this slide, I pulled this directly from one of Jay's quotes. Estimates are due April, July, October, and Jan. That won't change, but you can change when you pay in those periods. Jay, do you mind providing a little bit of more context around this statement?
Yeah, for sure. And this is when it comes down to your estimated payments. When you think about when your taxes are due, whether that's March 15th or April 15th, which is probably most of the businesses out there, when you extend your tax return, you're extending the filing, not the payment. And it's the same with the estimates. So if you are looking to have a better budget-friendly tax payment schedule, you could flatten it out and make a payment once a month if you wanted to, and have a very budget-friendly, I'm going to pay $2,500 or $25,000 a month versus $75,000 every 3 months or 4 months. And now that makes it very budget friendly. So you could set up your payments however you want, as long as you are making sure the minimum requirements are that, a quarter of it is in April, quarter in July, quarter in October, and the last quarter by January.
I'm going to ask a question. If cash flow is tight and you have a hefty tax bill, what's the recommend? Like, I know that we talked about paying late.
Yeah.
And you had mentioned that there are some scenarios where that might make sense. Do you mind speaking, or maybe not make sense, not the right word, but there are some scenarios where that might happen. Do you mind speaking to that a little bit?
For sure. And, there are cases where, a business scales so much quicker than the owners anticipated. And they get their income statements at the end of the year. We go and we do their tax returns. We do the S Corp, then we do the 1040, and they end up having to pay a large number, and they don't have those funds because what did they do with all the revenue that they sold? They sunk it in inventory. So in a lot of cases, they can't make that large payment. And there's always situations there. And the best thing is, and you should be making estimated payments throughout the year, but that first year, you're not going to know what to pay on those estimates. And if you're coming out of having a regular job, you might have met that requirement with your W-2, and you don't have those estimate requirements. But let's say you come out of the year and you have no cash in the pocket and you have a $50,000 tax bill. Well, there are ways around that. The IRS does have payment plans, and you can go right onto their website and complete an online payment arrangement. And they will basically look at breaking that tax up, and they will give you 72 months to pay it. They do put a little bit of interest in there. They do put a penalty because you didn't pay it at the due date, but they do work with you on that, and they will allow you to make payments. Now, let's say, you're coming into a high sales period, and let's say you're looking at a large summer sale, let's say a Christmas and July sale, and your taxes were due in April. Well, if that cash is going to be converted in 3 or 4 months, you can call the IRS and make a 4-month payment plan, and that would be off the books. They would record it. They wouldn't charge you a fee, but basically you say, hey, I'm going to be able to pay this off in 4 months. Can we do that? And they'll say, yeah, not a problem. You do that and you make the payments. And, that's, again, we're having a great accounting system and having a cash flow forecasting tool, like a dry run, so to speak. And dry run's a great product that we connect to Xero or QBO that allows us to build longer term cash forecasting than we can directly in Xero. And you can see where that cash is going to come in and where you can actually make those payments. So yeah, the IRS is kind of friendly with some of that stuff. And
I guess the key in everything that you're saying that you keep coming back to, which I think is compelling, is they are friendly, but you need to be communicating with them.
yes.
And that's important not to forget, right? Like, because you might not have the cash on hand now, and you're like, I'll pay it eventually. But the reality is, if you're working with an accountant, they can kind of guide you through that process, right?
Yes, for sure. And I will say the last 6 months, it's been so much easier to get through to the IRS. I mean, wait times, you'd be quoted, a year ago, your call will be answered in about 60 minutes. Well, that 60 minutes usually took 120 minutes. It's usually a 2-hour wait. Now it's like between 2 and 5 minutes, and you're getting halfway through that wait and they're answering. So it's gotten so much better and easier to communicate with the IRS. So yeah, I would definitely, look at that from a friendliness aspect. And, we as tax professionals know what's going on there, and we can help guide you through that for sure.
Awesome. Amy, I see that there's a question that popped up. Do you mind asking it if that's cool?
Yeah, no worries. I was possibly going to save that one to the end, but we just wanted some clarification around when estimated taxes are due, because I think there's been a few dates that have been thrown around between June and July, and then we obviously had those other dates. So could you just clarify that, Jay?
Yeah, so April 15th, I believe it's July, October, and January.
Got it. Cool.
Yeah, that April 15th coincides usually with the date the taxes are due and why they're due then. And then it splits out into that next month after the quarter. So, well, actually, it is actually the month after the quarter in April too. So yeah, it goes through that period.
Cool.
Perfect.
Where's it?
Thanks.
Could be June.
If it's June or July,
yeah,
that might have been a typo on my end. And if that's the case,
no, I'm thinking maybe
I am not the accountant.
There's so many different deadlines right now. So yeah.
It could have totally been my bad. And if it is my bad, I apologize.
I can tell you that when we do the returns, we spit out those vouchers, and they will tell you the dates of them. And we make sure that we tie that into what we're working through, and make sure our clients have that information properly.
So it sounds like they are April, June, September, and January. And if that is the case, then that was my bad, and I apologize. And thank you for the clarification. As it relates to the 3 scenarios, I think it kind of goes without saying that pretty much all of the advice that you just provided in that context applies to everyone here.
Correct. Yes.
Awesome. Which brings us to our next session, Amy. E-commerce accounting technology. So There are a few technology concepts that you have talked about leading up to this point. One is if you're moving to accrual, the need to A, have the appropriate accounting software, B, to appropriately connect your sales channels with that accounting software so that you can accurately track your sales, your fees, refunds, give every transaction type. And then the idea of inventory management. And then you also talked a little bit about cash flow technology. So there's a lot to cover in this area. If we can kind of splice it out, like first thing being most important is like, what tools do you need for accrual? And then what tools do you need for COGS and inventory management? And then the last piece, what tools would you need for cash flow?
Right.
So Amy, you want to go to the next slide and Jay can talk through. Well, there we go.
Yes. So regardless of what platforms you're selling on, you have to have a good accounting software solution. And when I say accounting software solution, I'm not talking about Excel. And, I mean, basically one bad formula and your Excel spreadsheet's going to give you bad information. So, whether that is Xero, QBO, Microsoft Business Central, SAP, or NetSuite, you want to have something that's going to be able to handle that load that you have. And, you want to start out right from the beginning with that and roll with it. Now, you don't need NetSuite when you're beginning. And in some cases, it does fit the bill. And when you need it, when you have multiple warehouses and you're selling on multiple platforms and you have hundreds, thousands of items, then a platform like NetSuite or Business Central would be great. But as you're starting out through that, SMB period where, small, medium business and you're growing, Xero is my tool of choice from the accounting sphere. And it makes it really super easy to get started with it. And, as you're growing and your needs grow, you definitely want to look at an A to X to bring in all those sales from all the different sales channels you have, whether it is BigCommerce, eBay, Etsy, Shopify, Walmart, and it make it really super easy to do that. And that gives you your sales, it gives you your cost from the aspect of, your Amazon settlement statements and all the other costs involved. Now, depending on what plan you have, it will do your COGS calculations as well. And what Amy was saying earlier, the cost is a little bit limited in A to X. Basically, you maintain a list of your SKUs and your cost. And based on that cost, it's going to book the entry to shift your items from inventory to COGS. Now, it's still up to you to put that cost in there and update it. And you might have to calculate it on a first in, first out basis, maybe on a weighted average basis to get that. And that's up to you how you want to do that. If you're not using a system, calculating FIFO is a little more difficult. But if you're tracking that inventory and you know what it is, and you can track each purchase of it, and we've done that in the past, we would update it whenever that lot or that purchase run ended and we moved into that next batch of product, we would update the cost in there and then it would actually start, costing it out at that new cost. So it's great for that. And it's great for smaller shops with a smaller number of items. I highly recommend using it with your Shopify and Etsy shops. And I do that with a couple of my own shops as well. So it makes it super easy to do it. And you don't have to put a lot of effort into it. Now, we look at tech masters that have products that they're manufacturing. You don't want to be using the, actually, you probably could if you can calculate what the items are and put that into A to X, but you're better off using an inventory solution to do that on it.
Or at least supplementing with.
Sorry, I missed you there, Jeff.
I was just going to say, or at least supplementing with an inventory management solution.
Right. And get a little bit better information there. And, from that point, you're going to have a lot more data about the products because you're actually manufacturing it. You're going to know how long it's taking and how many labor hours are going into it. There are a lot of different components that you can look at and measure when you're doing that, because now not only do you have direct and indirect costs involved there, you go back to your managerial accounting and start working on some of those variances and figuring out where you can start making more money on products as well. So that is some of the main components there. And after we're done talking about the inventory side, that's where the cash flow comes in. And, when you are looking at buying product, you have to know, number one, do you have the cash? Because odds are you're going to have to make a down payment. I know when I was doing it, we had to pay for 50% of it up front, and then we had 30 to 90 days for the other 50%. So we wanted to make sure that we had the cash on hand, or we had a line of credit, that we had available working capital to do that. And that's where something like the Xero short-term cash flow tool comes in, where you can look at 7 to 90 days and see what kind of cash flow issues you have in that shorter period. Or if you're trying to forecast that out for a year, something like Dry Run, where you can put in, it's going to connect to your accounting application, look at everything, and then you could build your scenarios over what you're going to be needing as far as cash, and it will be able to tell you what your cash availability will be, so that you can get those products you need.
Nice. So if I were to recap and based on our 3 scenarios for the S Corp, which was our Breezy Boutiques, the fashion designer doing 3 million in GMV, it sounds like you would recommend, if they're on the modified cash side or accrual, you would recommend A2X and Xero and or QuickBooks. Would obviously an inventory management solution might not be relevant for these folks. Would you recommend Xero's cash flow forecasting or Dry Run in their case?
So it's 2 really different animals. I mean, Xero is really short term.
Yeah.
And if you're in the base plan of Xero, you're getting 30 days. If you're in and I don't know the name, it's the premium plan on Xero. I think it's established.
Established, yeah.
I don't go by the names. I just go by what the numbers are. So if you get that higher level, or maybe it's growth, but you're paying a higher premium because, number one, you have multi-currency that you can use in that, and it comes with up to 90 days of cash flow forecasting, and you get analytics plus with that as well to give you a little more detail. But when you're really trying to build a cash flow forecast, you're looking at that a little longer term. You want to know what that's going to be over the next 90 to 360 days or even longer. So that's where a tool like Dry Run would come in, and you'd be able to get that picture of where you will be based on, I need to purchase $250,000 worth of inventory, and we need to have it in by X date to meet our Black Friday, Cyber Monday sale, and then the holiday season. So, that's how, like right now, if we were looking at that, the Xero tool wouldn't get us there. We'd have to, use a longer term tool to get a better cash flow forecast.
So it's not an or, it's more of an and, depending on what you're looking for.
Right. Exactly.
Yeah. Nice. And then on the Tech Master side, it sounds like A2X and QuickBooks under Xero for revenue reconciliation, maybe the COGS functionality, definitely an inventory management solution. And
sure.
Then Dry Run if they want long-term forecasting. And then on the healthy bite size, it would be the same, just minus the inventory management solution.
Yep, for sure.
Nice. Cool. All right. So next, well, unless there's a question, Amy, on this section.
There is quite a good question, actually. Someone's sent through a specific their case. So it's kind of like another case that we could look at if we've got time.
Yeah, absolutely.
Okay, cool. So it says inventory. We buy inventory wholesale. We sell retail and e-commerce. No WIP. What? It says S Corp, sales under 3 million. Any recommendations on accounting of inventory, and then tools?
Yeah, so Dwayne, that really depends on what your needs are, what your industry is, because a lot of the different inventory tools are better for different industries. So, I mean, if you wanted to reach out to me offline from here, and I'd be glad to have that conversation with you. You could reach me on Twitter at Jay Kimelman, and I'd be glad to have a conversation with you on that.
And I'll also share High Rock's email after the webinar with the recording, and then from there you can get in touch as well.
For sure.
Perfect.
Thanks for your question, Dwayne. Okay, so I think that wraps it up on the e-commerce accounting technology side. Now we're in a little bit more of the freeform section, which is the tax tips and challenges. I'm going to go into probably one question that everyone is thinking. If we go to the next slide, Amy, just bring back the scenarios. Jay, do you have any idea of what tax deductions each of these scenarios could potentially benefit from, given kind of the characteristics that are presented here?
Well, looking at Breezy Boutique, and yeah, they're looking at different types of fashion clothing. There's not a lot of R&D that goes into that.
Yeah.
There might be R&D in the process and the manufacturing process, but I don't see a lot there. I think that in a company like that, a lot of that is going to be, very low overhead, not a lot of equipment. In that case, there's not a lot to do there. Now, in the case of the manufacturer, though, there are some situations. And I'm going to say that Healthy Bites is a lot like Breezy Boutique in that situation too. But if you're a manufacturer and you're building production lines, there are a lot of different things you can do from that perspective. So, as you're buying equipment, there is accelerated depreciation that comes into play. Now, with the Tax Cuts and Jobs Act, I believe it's starting to phase out, and it's not going to be 100% this year. So you have to look at that and know how that applies to your company. And in a lot of those cases, when you're buying equipment for production lines, I can tell you in Florida, there is a manufacturer's exclusion to sales tax. So if you're going to be increasing your production and increasing your sales, you can apply to the state of Florida for a waiver on sales tax on equipment. And that, 6 to 10% sales tax number is pretty large when you're buying a lot of equipment. So that's something that's out there as well. But in the case of building tech gadgets and building technology, you might be doing some research and development, and there actually is that R&D tax credit that's out there. Highly recommend, if you are in that situation, to reach out to a firm that does R&D tax studies, and they can look at what your expenses are, if it qualifies as a qualifying expense, and give you an estimate of what that credit might be. That's one of the largest ones out there for manufacturers and companies that are doing research and development, whether it's building their own software or building software for sale, building products, and trying to find ways to build it better, and you're doing research on that. So that's one of the biggest things that I would recommend there.
I think what's interesting though is if you don't know, you don't know. And therefore, another benefit of working with an expert accountant that can kind of expose you to all of these different areas in which you can potentially benefit from.
For sure.
On the flip side of that, what are some of the common mistakes you see each of these scenarios make from a tax perspective, if any?
As far as mistakes goes, one of them is looking at your tax year and just going with a calendar year. If you are a business that is reliant upon the holiday season from Thanksgiving to Christmas, and you get 40, 50, 60% of your annual revenue that period, it's really hard to predict your tax situation and plan for that when the year is over on 12/31. So a lot of times in that situation, I would look at that and maybe make your tax year begin in October and have it end in September. And that gives you, plenty of time to start planning for your tax season, your tax filing and payments. And where the majority of your revenue came in, and then you can use your budgeting, to figure out the rest of the year. Whereas, that year-end push, you could have a great year, you can have a mediocre year. It just depends on what's hot that year or how things are. And you don't want to be reliant upon that. And, if you have record-breaking sales, you might not be ready for that, tax payment coming up in April. So
it's a really good point, right? Like when you just get started, you just think calendar year,
right.
You just think cash accounting, if you do any accounting at all, right?
Right. Right. Exactly.
And then you could be missing out on all of these. Like, again, I don't want to beat a dead horse here, but working with an expert accountant seems to be the key to get the most out of your tax situation.
For sure.
Before we kind of bring it into the Q&A, and although that we had kind of quite a bit of Q&A during the actual webinar, anything that we might be missing here from a tax tips, tricks, or challenges perspective?
For the most part, I think we covered most of that. I would just want to say that, it's important that, and I've said this before, whether you're running a business that's a flow through, which is an S Corp or partnership, if you are running a single member LLC, which is taxed as a sole proprietor on a Schedule C on your 1040 by default, if you're the only member of that LLC, or a C Corp, every tax scenario is different. And you want to look at that from the specific requirements of you, your family, your business. And, like I said earlier, you might have 3 shareholders in an S Corp, and, you might be only working your job at your company, getting your paycheck, and then you're getting your income flowing through your K1. Your partner might have a wife that is an executive that's bringing in X dollars, and, that's going to add different complexity. You're going to have, different amounts of deductions, all that plays in. So you can't just, hear from the guy in the school line that says, hey, this is the best tax strategy to go about. Or, I know there are e-commerce coaches out there that say, these are the top 3 things you should do. Well, that might be the top 3 things in their situation. You've got to look at it from your specific tax situation and from your tax filings and your real life. And that's the most important thing.
Yeah. What's funny is it's a really good point. There are a lot of pieces of TikTok advice that sometimes might not even be categorized as advice because it could steer you in the wrong direction. So yeah, make sure to consult with an expert. Every situation is unique. And I think we've kind of covered that, like from picking the right accounting method to the inventory method, to the technology that you use, to the different tax deductions that you have available to you. It is like incredibly unique. There's no one size fits all. But I will say, Jay, thank you so much for providing your insights and your perspective. I hope this webinar was helpful for everyone that joined us, and then also for those that are watching the video on demand. We'll give another 2 seconds for Q&A, but if they don't come through, thank you for your participation. Thank you for joining us, and we'll send a follow-up email with more information on HighRock, more information on A2X if you plan on moving towards modified cash or accrual. And yeah, we'll be happy to help you from there. Thanks, Jay. Thanks, Amy.
Yeah. Thank you, everybody.
Talk to you soon.